The average American leaves $47,000 in dividend taxes on the table during retirement, but you don't have to. What if I told you that you could own dividend stocks paying 5 to 8% yields and never pay a single dollar in taxes on that income? Not someday, not after some complicated strategy, right now. I'm talking about putting high-yield dividend stocks under $20 inside your Roth IRA, HSA, and 401k, accounts where the IRS literally cannot touch your gains. Hi, I'm your host here at Tax Shield, and today we're breaking down the exact tax-advantaged dividend stacking strategy that could turn a $50,000 investment into over $400,000 in tax-free dividend income over 30 years. Let me show you the math first, because this is where it gets wild. Imagine you invest $10,000 in a dividend stock yielding 6%. In a regular taxable brokerage account, you're paying roughly 15 to 20% federal taxes on those dividends every single year. That's $900 to $1,200 gone to the IRS annually. Over 30 years, that's between $27,000 and $36,000 in taxes paid on a single $10,000 investment. Now put that same $10,000 in a Roth IRA. Same 6% dividend, same stock, zero taxes, ever. Not on the dividends, not on the gains, not on withdrawal. That's the difference between retiring with $97,000 versus $130,000 from that single $10,000 position. And if you're aggressive with contribution limits and rolling over old 401ks, you can multiply this across multiple accounts. Here's what most people don't understand. The tax shelter is more valuable than the dividend yield itself. Your Roth IRA can hold any stock. Your 401k can hold dividend stocks. Your HSA, which is the most underrated tax advantage in America, can hold dividend-paying stocks too. Let's talk about the HSA specifically, because this is where the magic happens. An HSA is triple tax advantaged. You get a tax deduction going in, you pay zero taxes on growth, and you can withdraw tax-free for medical expenses. But here's the secret. Once you hit 65, you can withdraw for anything, and it's taxed like a traditional IRA, so it becomes a stealth retirement account. If you're 35 with a $750 annual HSA contribution limit, and you max it out for 30 years with a 6% dividend yield, you're looking at roughly $985,000 in your HSA, almost $1 million partially tax-sheltered, sitting in dividend stocks under $20. Now let's talk about specific plays, but I want to be clear. I'm not recommending these as stock picks. I'm showing you the category and the structure. You're looking for stocks trading under $20 with dividend yields between 5 to 8%. In 2024, this includes names like Energy Transfer, ET, trading around 16 with a 7.8% yield. Or Maine, Gladstone Capital, trading under $20 with a 9% yield. Or Realty Income, trading at various prices under $20 with a 3.8% yield and monthly distributions. The monthly dividend from Realty Income is a pattern interrupt itself. Most stocks pay quarterly. Monthly compounding in a Roth IRA is wealth acceleration on a different level. But, and this is critical, you need to understand the structure before you execute. Here's the sequencing strategy that most accountants never explain. First priority, max your Roth IRA. That's $7,000 per year if you're under 50, $8,000 if you're over 50. This money grows completely tax-free forever. Put high dividend stocks here. Second priority, max your HSA if you have a high deductible health plan. That's $4,150 individual, $8,300 family in 2024. This is your second stealth retirement account. Stock dividends in here compound with triple tax advantages. Third priority, contribute to your 401k up to the employer match. You need that free money. Then if you have income remaining, consider backdoor Roth contributions and mega backdoor Roth conversions through your 401k if your plan allows it. Fourth priority, after-tax accounts. This is where dividends get taxed, so use this strategically. The key insight, dividend stocks under $20 belong in buckets 1, 2, and 3, not in taxable accounts if you can avoid it. Let me address the obvious question. Why aren't dividend stocks under $20 more popular? 3 reasons. First, they're often overlooked because they're not mega cap blue chips. A $16 stock feels risky compared to a $150 stock, even if it's the same company. Psychological bias. Second, most people don't know they can hold them in retirement accounts. They think retirement accounts are for index funds and ETFs only. They're not. You can buy individual stocks in Roth IRAs. Most brokers allow it for zero commission. Third, and this is the big one, financial advisors get paid on AUM, assets under management. They make more money managing your $500,000 portfolio than showing you how to shelter dividend income. There's no incentive to tell you about this strategy. Here's the execution checklist. 1. Open a Roth IRA if you don't have one. Fidelity, Charles Schwab, or your existing brokerage will work. 2. Confirm your HSA is invested, not sitting in cash. Most HSAs default to money market accounts earning 4 to 5%. You need equity exposure for this strategy. 3. Download your 401k documentation and look for the investment options. If your 401k allows individual stocks, you can put dividend stocks there too. Most don't, so check. 4. Set up automatic dividend reinvestment, DRIP, in your accounts. This compounds the magic. Every dividend buys fractional shares which earn dividends which buy more shares. 5. Rebalance once annually. Don't trade constantly in your retirement accounts. That defeats the tax advantage purpose. Here's a scenario that should excite you. You're 35. You max your Roth IRA at $7,000. You max your HSA at $4,150. You contribute $23,500 to your 401k to hit the employer match. That's $34,650 per year going into tax-sheltered accounts. You put all of it into dividend stocks under $20, averaging a 6% yield. Over 30 years, assuming 7% annual returns, 6% dividend plus 1% price appreciation, that $34,650 annual contribution becomes approximately $3.9 million. With dividend reinvestment, you never paid federal tax on that growth. Never. The taxable brokerage account version of the same strategy with the same $34,650 annual investment and 7% returns nets you roughly $2.8 million after taxes on dividends. The difference? $1.1 million, purely from tax advantages. Let me handle one objection. What about dividend cuts? Valid question. Dividend cuts happen, but here's the thing. If you're in a Roth IRA, it doesn't matter tax-wise. A dividend cut doesn't create a tax consequence. You didn't overpay taxes on a dividend that goes down. You simply adjust and move to a more sustainable dividend if you need to. The tax shelter absorbs the volatility without creating tax complications. This is different from holding dividend stocks in taxable accounts, where you might sell at a loss and create tax loss harvesting complications. Final principle. This strategy works because of time and compounding, not market timing. You don't need to pick the perfect dividend stock. You need to pick sustainable dividend stocks, shelter them from taxes, and let them compound for 20 to 30 years. The best time to start was 10 years ago. The second best time is today. Your next step: audit your current retirement accounts. Open your Roth IRA statement. Check your 401k and